How are you? Enzo DiCostanzo, clinical professor of economics and finance, St. Peter's University, Jersey City, New Jersey. Today, we're going to be working on the first Excel lecture for the summer course, and certainly in the fall. If the folks were using this again in the fall, you'll see the first Excel lecture for this particular topic. So you guys have the template. Blackboard, go to the Blackboard link when I share the screen, and we can discuss that very quickly, and then we'll get right into the Excel. Okay. Okay, folks, looking at this, this is the Blackboard site for the course. Just the first two buttons is what you're going to need: the announcement button and the syllabus and schedule button. The announcement button, I'm going to keep, overwriting this with new links and new times. We've already got 2 videos up, and the videos are right here. You can just copy them. Whoops. Actually, these get sent to you by email. Yeah, so Blackboard, for some reason, I don't know why, but at one time you used to be able to hover over these and click on them, but these are in your email, and from your email you can because I can't highlight them here, but maybe on your version you can, because I'm the professor for this course. But these are the links for the videos, and they're in the emails. So as you get the emails, you can just click on them. I saw it the other day because I get a copy of that, and I repeated them here. So these are the 2 PowerPoints. Now you see down here, there's some dummy links. These are just holding the spaces. These are for all the Excel links. I'll put the hours and the minutes. So far you have over 2 hours, easily over 2 hours of video to watch. Folks, you have to watch the videos. Okay, I can tell how many people click on them, and we don't have everybody clicking on them. And I send them to my cousins, and so it could be even some of them clicking on it. So we certainly don't have 10 people clicking on them, or whatever it may be, because I click on it once myself. My cousins might do it, and there's got to be at least 10, and you got to watch them, not just watch it for a couple minutes. You got to watch it all. So in this particular chapter, actually, I was thinking about this the other day. I don't know how you're going to feel about all sort of asynchronously, in a sense, where I make the video, I send the video, and you watch it when you can. But we might do something where, I was thinking about this, we will all get on together. I'll send you an invite link for the meeting, and we'll all link on together, and you guys are going to share your screens one by one, and you guys can explain to me. I'll maybe give everyone like a specific problem to explain sort of online or something like that. It was just something that I was thinking of where, you have to be able to work Excel. I had a situation over the last academic year. A nice kid who was in a couple, was in 2 of my classes, and it was a little astonishing to me that at the end of the second semester, even though we had the virus thing and all that, but I would ask him questions in class, and I could see he pulled out a calculator to do the math instead of using Excel on his laptop. Now, I don't know if you don't want to tell me he didn't have the software uploaded, which is kind of amazing, to be honest with you, that you wouldn't have the software after working with me for 9 months. But I could see, he's so, and I had some suspicions that some of his work wasn't his, but I never really had proof. But you don't want that. You don't want to have to tell you, hey, improve this, improve that about what you're doing. But when you go to work, and again, a number of you who are working know this already, people aren't necessarily, and people, they're not your career counselor, the people that you work with, or even the people who are your supervisors. So you've got to be able to diagnose how you're doing with everything. And if you don't, you might just get a letter one day saying, hey, we're letting you go, and that's it. So be happy that I'm pointing out stuff to you about different things, because I think that's important. That's my job, is to say, hey, you got to improve, and in a very Jesuit way, in a very Catholic school kid way of doing that. But you've got to be able to sit in front of Excel, type in numbers, add them up, be comfortable with it, and not be all thumbs at it. So this might be a way to go, where we'll have just a whole meeting about this, and we might do it once, maybe, or like around June 15th, or like the middle of June or something like that. Maybe we maybe just we'll try that, and a couple of you have worked with before. So, and even Joe Haley, when I was doing the emails, I noticed you'd emailed me a long time ago about a couple different things. You were going to come to one of our accounting classes, and I don't recall whatever happened with that. But there was a number of people who you have experience with you one way or another. Genesis, obviously, she's been for a bunch of classes. So so you guys know, a little bit about, working with it. But like I said, I'm going to fill this out as we go along. Okay, so just know that this is just going to be overwritten every time. When you go to syllabus and schedule, we have the textbook here. So this is just like the email. So there's your textbook file. The syllabus is here. Again, for legal reasons, we have to give you syllabus, but you guys know from the emails what you need to do. Here's the PowerPoints, which are here. Okay, you have all four sets of PowerPoints are all in there, so it's all in here. The assignments will just build up the assignments. And actually, about the assignments, these are just the assignments right now, but I'm going to work it out where you can deposit them on the site. Okay, so just give me a little bit of time to work on that, but hopefully the next couple of days. Several people have already emailed me assignments, and just hang on, just make sure you have those organized and you can kind of hang on to them. But I want to work on you depositing them sort of on the website. And here's the Excel files. Now, if this was with the live class, I have an Excel file for what we do in class, an Excel file for the homework. But here it's all just one file. This will continually get updated. So you should be copying and pasting from this into your Excel that you experiment with. Don't experiment in this file, and don't send this back to me. And the reason I know is when you send the file to me, it's got the same name that I sent that I posted here, and that's how people say, "Well, how did you know that you sent me back the same file?" That's that's again a shortcut way of doing things. You want to have your own file, and just being able to work like this, manipulate the files, and be used to working like this. This is a big deal. And I do it in all my classes. It's easy to take it for granted sometimes. This is just how I do things. But this is how when you work at a high level, when you work in a bank, and work for the Federal Reserve, you do these high level jobs in New York. Analyst or whatever it might be, economist or something. You want to be able to work like this with emails and attachments and keeping everything organized. And the other thing too is this, and I've said this a couple different times. You want to have a folder with all your documents in one place that you created, not just waiting for me to put it on Blackboard, kind of a thing. You created this. I say this all the time. Okay, so but let's get to the first Excel exercise that we're working on, and we're going to do that right now. So this is your file on the left. This is just my little sort of reminder of what we're doing as I go along. But this is the file that you're working on. Okay, so just keep that in mind. Okay, this is supposed to be almost like you can't read it. It's supposed to be that. That's not an accident. This one's the one I want you to be able to read. This one's the 140 or the 150 or whatever it might be. Okay, again, the objectives of this chapter, and again, we're going to be repeating things. So you have a couple hours of PowerPoints the other day, 2 separate videos, and now we're same thing, why bonds are issued, prepare the entries for the issuance of bonds and interest expense, the entries when bonds are redeemed or converted. That's what we're going to do today. We're going to do the first 3 in Excel today. These other 3 we're going to do in an Excel probably tomorrow night. I'll create that video. For this is capital leases and the long-term payable notes and presentation analysis and that type of thing. This is all just a repeat, so you guys are familiar with that from the video, okay? From the previous videos. What a dividend is, it's again, when a company makes money, they distribute it as a dividend somehow, and a part of the earnings. There's when a company makes money, there's 2 things you can do with that money. You can reinvest back into the business, or you can get paid. Or 100% of the earnings can just be the owner's profit, and that's all worked out beforehand. That when people invest the capital, what do they do? Type thing. So if you own 10%, you receive a 10% of the dividend, or 10. Now the dividend and the earnings may not be 1 for 1. The earnings could be, let's say the earnings are $100, the dividend could be $10. So 10% of that is $1 type of thing. So that's how it's sort of, or if it's just all the earnings, that's just 10% of all the earnings. But usually there's some reinvestment back, into the business. Bond is a form of interest-bearing note payable. It's how you get large amounts of long-term capital. Corporate managers decide issue stock or bond financing or stock financing, and we had an example, and actually, it's actually right here, and we're going to go over this right now. This numerical example is we discussed this in the PowerPoints, but we're going to look at it now. Should you take a loan to do financing, or just have direct investment and then people just sharing the earnings? What's the best way? Now with the loan, you can control dividends, and you can say, hey, we're only going to put out 25% of the earnings as dividends, and you can control that a little bit better. The earnings, if the company does really well, these and somebody has 25% of the business, that's a big hit that they're getting. So, okay. But yeah, these are just stockholder control. Again, these are things we talked about in the PowerPoints. Tax savings, earnings per share. Okay, so all of this, and you can see it's all very self-explanatory here. If there's interest, it's if you're paying interest on debt, you're reducing your earnings, and you have less. There's less of an income to tax. Okay, so just there's a built-in tax benefit in addition to wherever you may be working. If you're working overseas, if you're working in some Essex County or some county in New Jersey somewhere, there may be different benefits to the local municipal government may give you, the local state government or something like that. Yeah, earnings. Yeah, now if there's less equity financing, there's less shares out there, so you're dividing it among fewer people. There's no requirement that if you make a loan to a company that you have to participate in the earnings, in a sense, meaning beyond paying the interest and the principal back type of a thing. Okay, so we're also going to, that's, and again, it's how you structure this. And folks, with an attorney, everything is, or with a contract rather, everything is possible. It's whatever you can agree to, and believe me, that's easier said than done. That's for sure. So yeah, so we have this numerical example here. It says illustrate shows a reason the bonds that they don't affect the stockholders' control. Bondholders have voting rights, and the owners of the company, the founders, can still maintain corporate control to a point. Yeah, there's a built-in tax benefit because you're paying interest, so that lowers your taxable income type of a thing. Okay. So there's equity financing and debt financing. Those are your two choices. This was in the textbook. So what happened here? So we started this with, and folks, again, see all these gray boxes, because obviously I do a lot of these videos and lectures, and I'm not going to just remember, that I got to fill in, however many cells I need to fill in. So I just sit here and I gray out sort of these cells. See what I did here? Okay. So what's happening here is income before interest and taxes, 1.5 million, 1.5 million. Is that right? So that's income before taxes. So there's two scenarios here. There's a scenario, a stock financing scenario, then a scenario that includes some kind of debt. And what we're going to do is the interest for the debt is going to be 8%. And notice how I'm doing this. You have to get rid of the gray boxes. And again, there's people in the semester who completely miss that. And I do it in class, and just again, it's just people who just simply aren't tuned in. And it's frustrating, but it's also sad, because I know the consequence of sort of swinging and missing it at college. It's not a good outcome when people are telling you very good things and then you're just not tuned into it. That's something that I don't really wish that on anybody. It's a $5 million loan that the company takes. I'm just typing in the 5 million. Again, I'm clearing. You could just click on, see where it says fill, just no fill. I have the shortcut. It's Alt HHN. If you just use the keyboards. There's a whole. Let me see if I can find it for you real quick. I used to give this to people. I used to work for this firm. Yeah, here it is. Yeah, same document. And actually, there's a more advanced one. And this talks about all the different. So just type in Wall Street Training Excel shortcuts, and you get this PDF file. This was a great experience. I don't want to say it made me where I am, because that's not really true, but it helped me a lot to get to the point where it just sort of reinforced and reaffirmed, working in Excel. And the guy who runs this firm, I have a tremendous respect for him, but things. You're going to go out into the world and you're going to see everything's not going to be very cut and dry, especially in business in New York. Big sums of money are involved, and that can alter how people act, and just always be aware of that. So anyway, but looking at this, control 1 is formatting the cells, and Alt, the drop down orders, drop down options, alt with the down arrow, and the control plus or minus, and you just, like I said, the arrow keys and the shift keys and how to select the cells. Again, I could go through every, the auditing. Here's alt TUA, removes the auditing arrows. But I have one that's like 4 pages long. There's a thicker one. There was a, yeah, there he is. There's a guy. He's a CFA charter holder. Closing the Control S to save or open or whatever. Control W closes the files. The Windows button minimize, and Windows M or Windows D minimizes or shows the desktop or gets to the desktop. Like I said, you just go one by one, control page up or control page down, what that does for you, and selecting the rows, selecting the columns, whatever. Like I said, I don't want to sit here go spend too much time, but you guys, or other ones. There's another firm, Wall Street Prep. Yeah, they have a list too. Okay, of it. They're up in Boston. These guys. This firm, I think, is a little bit better than the firm I worked for. But I was happy to work for the firm I worked for. But these guys, and the firm I worked for benefited from being in New York. These guys are in Boston. But yeah, these guys, they're a bigger group. There's more. They're just bigger. And that's just it's control bold, how to do both, control B for bold, and they have the Apple and the Windows keys. Okay, how to clear and yeah, it goes on. It's this kind of stuff. And like I said, this is overwhelming to look at all this. I know this is overwhelming to look at all that. But you want to and don't be careful with the training stuff, and because it doesn't count for college credit. This type of thing. This makes sense if you're working for a Bank of America and that type of thing, and they're going to pay for it. That's when it really makes sense to do all that stuff. It's tough to do it just on. I'm not saying I'm going to discourage you from just independently working on it, but just keep in mind that that's better, because there's corporate clients and there's individual clients. The corporate clients where the firm is backing you to do it and all that stuff, and you want to go that route. Anyway, I don't want to make it a marketing thing for those kinds of things, because it doesn't count towards college. But my courses basically are giving you the experience you would have had, in any of those sort of training situations. So you're pretty good with that. So anyway, so look at this. There's if it's stock only financing, right, type of thing. So again, you're not looking at plan A and plan B. You're not looking at, okay, well, there's an equity investment because you don't have that information for this particular example. But what you do have, if there's a $5 million loan, right? So you say equals negative, because it's an expense, 5 million times the 8%. Okay, so that's the principal it's owed. So expense is what you would have. So the income before taxes is that, and the income before taxes for plan B is going to be less. Okay, and why is it less? Because you have a $400,000 interest expense. So again, I said this in words on the PowerPoint, but now you're seeing how to do all this. So here, let's just sort of go back as slowly as I can. Oh, and I want to mention this. The blue font, see how this is in blue? This is an input. I just entered 1.5 million, 1.5 million. This is 8%. I pre-formatted all these cells, so I'm not really spending a lot of time with the formatting, but you should, if you hit Control-1, right, and just give it a second, yeah. You'll see the little formatting box and percentage, number, accounting, and you've got to, I could talk about it until I'm blue in the face, but you've got to get comfortable with this. And anytime these little sort of percentage numbers, I make them a notch smaller font-wise, I put it in italics. You don't want this popping out so much. You want these numbers to be a little more prominent than something like this. This is just, and you'll never see this in like an SEC document. This is just for when you make your model yourself. And folks, I'm telling you, I'm just here to teach you, how to make these models and how to think about it. So this is just a summation. See the formula? O48 is column O, row 48. O49, column O, row, and I'm just put a colon in the middle and sum them. I could just did it like this too. All right, I can do it like that also, where you just add them, right? That works too. But I like this is a little more sophisticated way, using the summation function. Now, the colon means the first argument and the last argument are endpoints. Now these are just two rows, but you could do 20 or 30 rows, and it would be colon 048 colon 078 or something like that for 30 lines or something along those lines. If you put a comma, the comma just takes them each individually, so it would only as many rows as many cells as you list. When you put a comma in between them, then that's what will get added up. Okay, so just keep that in mind. So that's what that is. And now, obviously, with this one, your income before taxes is lower when you have a bond. So you're analyzing, okay, if I take out a loan, how's that going to affect my income before taxes? And then you want to put your tax rate in. Again, we're just sort of making an estimation here. Again, equals negative because it's an expense. Your income before taxes times 30%. And now here, I want to say, actually, this is just a multiplication. Right, and it says equal. You need an equals when it's a formula, equals negative 051, and then shift 8 for the multiplication symbol, and 52 type thing. Okay, and then what you want to do is, see, I'm gonna go to the middle of the green N52, the percentage for taxes. I'm gonna hit F4, or you can just type it in. And if you see what happened was there's a dollar sign in front of the 52, there's a dollar sign in front of the N. The N is the column, and the 52 is the row, which is it's right here. The number, the percentage is right there for tax rates. So what you're doing is you're locking in where when you copy and paste into other rows, it still will reference that 30%. I say control return. Control return, and see when you hit return, it starts moving down. When you hit control return, it keeps you in the cell that you're working in. Hit Alt HHN. Whoops. Alt HHN. Now I want an underline. I want negative. So what I'm going to do, I'm just going to go to next to that cell, then hit Control R. It brings over the operation, the income before taxes for Plan B, but it locks in the 30%. So looking at the income tax expense, obviously you have a lower tax expense when you use debt because you have a lower income before taxes. Okay, and now the same procedure here equals sum parentheses. You're going to add up those two. And then say Control R. So you can see you have a lower net income with bonds because you're paying out, you have an interest expense. You have a higher net income with stock. So, I'm not saying that obviously you want to just take out loans just to lower your income just to pay less taxes. I don't think there's anybody that would really want to do anything like that. But, there could be reasons to engineer sort of what's going on. With the stock situation, again, this is just our example. We have 300,000 shares. And they could be, a lot of them could be the same person. You can't say, oh, well, it's not going to be 300,000 individuals. It could be groups or institutional money or something like that. Oops. Yeah. And now earnings per share, the classic computation is the net income divided by outstanding shares. And you can see how the formatting there. It's double underlined. It's bold. So if you hit Control 1 and you go to font, see, it says double accounting underline, and it's accounting formatting in 2 decimal places, and it's bold. Go to the font, it's bold, and the points are, it's 11 font size. Okay, so now you have a higher earnings per share because you did less equity financing. You have a higher EPS, but I'm always a big and notice this. You have a smaller net income, but a higher earnings per share. So you have to know the moral to the story of this example is you have to know your numbers. Okay, this is very short. Okay, this is a short, quick little thing here. Okay, but there's a lot of these. We're gonna have models that go 100 lines in this course very soon. So, like I said, look, I gave you the chapters to read. Read those 4 chapters. But in terms of the models, who knows how far? It just sort of depends on you guys and what the feedback is and how you're doing with all this. Okay, like I said, you have your 4 initial assignments are pretty clear definitions. Now, with the self test, again, I had a couple of people ask me about that. The reason, I gave you the template, and we'll get to it in a second. See, this is the template for the self-test. I prefer you just worked in this and just sent me this. And see, some of them need computation. So the reason I gave this to you in Excel is so you can do some of the math in Excel. Don't just do it on a piece of paper. You have to work out some of this. Okay, I'm gonna go over this. Like I said, probably midweek there'll be pardon me for that sound. There'll be a video on this. I'm working on the investments chapter and all that stuff. So let's certainly work on that. Okay. But yeah, so there you go. There's your equity investing versus debt financing example. Okay, which is what that is. Oh yeah. So pardon me. This was the whole. This was the narrative was at the bottom. I apologize for that. 1 second. I'm sorry. I can't pause this video. Like when we use Zoom, you can pause it and go back. With Google Meet, you just hit it once and then it doesn't have the capability that Zoom has. I thought Zoom was a little bit sharper with video, but we're using this one now for some reason. My operating system is only Windows 7. Windows 10 is out there, and I got to upgrade to that pretty soon. But but here's what's going on. So this microsystems, they want $5 million for a plant. So here's the principal. That's a very low number. Believe me, you can spend $5 million on redecorating an office. So that's a low number, but that's fine. So Plan A involves 200,000 shares of common stock. Yeah. Okay. So it issues 200,000 shares, and the market price is $25 a share. Okay. Yeah. So here's what happened with this. See how you have 300,000, 100,000? The baseline was 100,000 before you needed the financing. The 200,000 were added because the equity investors all of a sudden made that investment. The deal they made was, we want 200,000 shares of the company. So they want 2/3 of the earnings, 2/3 of the income. That's how you interpret that. Because if there's 200,000 shares outstanding and they have some group has 200,000, that's 2/3, right? So that's how equity financing, debt financing. There's no extra shares issued, but you have interest that you have to pay, and the principal you have payments that you have to make. Here's the income taxes. So yeah, the narrative is at the bottom. So I apologize for the narrative was at the bottom. But like I said, you guys have this. I'm gonna post this to Blackboard. Once I get through it, and you should sit and practice this. Okay, you should sit and practice this. This is the real stuff. Okay, this is what that Wall Street prep and the Wall Street training. This is what those firms did. And here there's a whole discussion here about advantage and disadvantage. And I've already said all this. There's interest payments that are due, and that the principal that's due that lowers the earnings, and you're gonna have certainly lower earnings, lower dollar amount. It's the same percentage with dollar amount, lower taxes and lower tax expense. Okay, like I said, there's a whole discussion here about that. You guys can read through that. So we talked about this: secured bonds, unsecured bonds, term and serial bonds. Okay, this has a specific asset issued as collateral, and this is a debenture issued against general. How much we believe the Trump and Johnson & Johnson can generally get good credit. They're going to say hey because we know you have money because it's public knowledge, and Bloomberg, and just based on your reputation. But most people get secured. Even in New York, most people are going to get that. Bearer coupons, registered bonds is the name of the person who not necessarily the person who physically has it, but it's registered in the person's name. A bearer bond is just that. If you have it in your hand, it belongs to you, type of a thing. Most of them are registered. And then again, all the different definitions, the convertibles, and actually here, yeah, you need a maturity date, a contractual interest rate, and we're going to deal with all of this stuff in the problems. Okay, we're going to be dealing with, and like I said, this is all for you guys to read. This is basically just the textbook. Okay, so there's really no mystery to where any of this came from. Yeah, there's an exercise here that's some questions, and we're going to go over the questions right now. The market rate of interest is the rate investors demand for loaning funds. Now, again, this chapter, this is a double chapter. Okay, this is really a double chapter, and the 3 appendices are going to take, that's going to be next week's videos, because I'm going to do this video and probably one tomorrow, and then we'll do the self-test video, and then we'll do each appendix, not maybe each appendix, but the appendix, or maybe because those models, those are some long amortization tables and long scenario table situations, or long cash flow table situations, and we're going to spend some time on it, but certainly anything that's a loan, there's a dollar amount received, there's a length of time, there's a rate of interest, and there's a rate of interest in terms of if you're the instrument buyer, what you're paying for. But if you're the person getting the capital, all you really care about is the contractual interest. You care what interest rate impacts your interest payments. Now once that bond is issued, or once that loan is made, and there's an instrument that's floating out there and getting traded, now there's cash flows associated with that instrument, and people are going to be buying and selling those theoretically based on they want those cash flows. So they're going to be the recipient of the interest payments and the principal payment at the end. What people will pay for that is really the subject of this course. Is really what it is. It's a subject of corporate finance that involves market rate of interest. I go through that in the a little bit later in the appendix, but just put it in evaluation of a set of cash flows that investors are buying. Now, with just buying shares in Johnson & Johnson or buying shares in Amazon, buying shares of the company, you're theoretically buying the dividends, and you're anticipating the company more valuable in the future, and you're anticipating an appreciation in the stock price of that company that's going to make your shares more valuable, and, unless you need the money when a depression happens or some, and folks, again, you guys are mostly 20, 25, whatever it may be, but about every 7 to 10 years, something's going to happen. And I knew we were just tempting fate, because it's been a good 10, 12 years since the financial crisis, and really nothing bad has happened. So we were due for sort of something, that sort of happened here. And now once you get on television, people aren't talking about the virus as much and type thing. They're talking about the impact on the economy and people's businesses being closed, and we haven't seen some of this since in 108 years, and you're hearing all those kinds. But don't worry, we're gonna, the world wants what we do. We want what we do in this country, so that's gonna dominate what happens, going forward. And you have to remember, this couldn't have been worse for an incumbent president who was seeking re-election in November, which is coming up. It's really around the corner. It's June in a week, June, July, August, and this is not going to be a summer to speak of. That's for sure. This is going to be very unusual. You just put your head down and work for the next 6 months, or through the winter, because we're hearing there'll be a vaccine around Christmas time or something. And but it's gonna be a tough. Emotionally, it's going to be a tough year. That's definitely going to be true. Like I said, take advantage. Take classes, study, work on yourself right now. That's my best advice to you guys. And I'm going to probably, I don't know if we're going to do it for the summer, but I'm going to produce some video that talks about the economy and employment numbers. And I'm going to do some stuff like that, and put it out there so you guys can be at peace that, believe me, we're still the strongest country in the world. And look, I'm not a fan of China. I'm not a critic of China. I'm very neutral. I mean, if there's something good that we can do with the country of China, that's great. But I'm very neutral on that topic. But certainly, you're hearing. I'm hearing things from some of the political commentators that this was sort of the death knell for that sort of country. But again, you'll get the right wing guys that's saying, oh, it's communist, it's this, it's that. But but really though, Walmart, we wouldn't have a Walmart if there was no China. If pretty much everything that's made in that you buy in Walmart is somehow one way or another made in China, or it has something to do with materials from China or something like that. When I went to college, and a lot of Asian American folks were my classmates, and I was, I always got along. I never said, oh, that's some guy from China. I never really thought that way. There's people who think that way, but I'm certainly not one of them. I take people for what they are. There's good folks, no matter, India, where our doctors from India. I remember a really good, I think it was from Taiwan, a really good physics teacher. I remember way back in high school, not high school, and in my initial years in college. Very good guy, smart guy, and learned a lot. Dr. Lee, I forget his first name, but I learned a lot from him. In physics. He was a nice guy, nice man. I remember very clearly spending some time with him. So anyway, let's get to the exercises here. Okay, sort of what we're doing with this. These are true and falses. So let's look. It says mortgage bonds and sinking funds are both examples of secured bonds. Let's see, mortgage bond and sinking fund. Where do we have that? I know that we had this in with the example. And if you guys just bear with me for a second, let's get to the textbook. I should have had this open before. I apologize. I just want to show you guys how to find. Obviously, we know the answer to that, but yeah, I just want to show you guys how to find everything as we do this. There, there's a nice glossary here, and we have some of the definition. And again, this is why I had you guys work on the definitions to this. So what are we doing here with this? We were looking for mortgage bond and sinking fund. Sinking fund, bonds secured by specific assets, assets set aside to retire them. So sinking fund, bonds secured by specific assets set aside to retire them. Okay. And the mortgage one is this a note? No, this is just a mortgage bond. It's bond secured. Yeah, this is secured by real estate, and this is secured. But yeah, real estate is an asset, and specific asset are assets. Okay, so are these both the same? Yes. Okay. Which that's true. Unsecured are also known as debentures. Yeah, debenture bonds, the general credit, sure. So that's also true. The stated rate investors demand for loaning funds is a contractual rate to determine. No, so this is false. So yeah, the stated rate is not the market rate or the rate investors demand for loaning funds. That's a different. These are two different separate things. It's a contractual rate issued to determine the amount of cash flow or cash interest that the borrower pays. So that's false. Face value is the amount of principal issuing companies pay at the maturity date. Well, contractually, yes, but if it, that's true. But if you redeem early, you're making a deal because someone is not getting the rest of those interest payments, but to retire early, maybe you can make a deal with them, and you may pay a little more than the principal. But theoretically, that's true. And then it says the bond issuer must make journal entries to record transfers of its bonds among. No, false. So if the instrument is sold, it's the issuing company doesn't make journal entries every time. That a trading firm or a pension fund or something like that, and you're buying it, sure, then you're making entries, but you're not doing that. And that's the subject of the next chapter. But you're not making entries. The issuing company, the company where the loan, the company issued the bond to take, to do debt financing, they don't make a journal entry every single time that the instrument changes hands. That is true. Or false, rather. Yeah, that's false. Okay. Yeah, so yeah, look, that was, I didn't want to just end at that. So we have these other two sections here that we're going to work on. Okay. Corporations record bond. Yeah. So yeah, Candlestick Corporation. Now again, these, I don't know if it's, I don't recall off the top of my head, but I think probably one of the authors is probably from San Francisco or went to school in San Francisco or the San Francisco area in California. Because Candlestick, at one time, there was a baseball stadium where the 49ers played a long time ago, and the San Francisco Giants baseball team played there, and it was right on the bay and very windy and all that. And Barry Bonds played there for a number of years, but obviously one of the guys, I'm sure, there's a lot of sports, football. I catch the names because I sort of know the players, but I catch there's a lot of sports references with the names that they pick for some of their examples. But Candlestick Park was right now it's called something else, and I think it may not be in the same location. It might be. What happens is, like with Yankee Stadium, the old Yankee Stadium is a parking lot now, which is almost heartbreaking. That was the first place I went to see a baseball game 40 years ago. I remember very clearly. Cleveland, and then they lost the Yankees lost 5-0 to Cleveland. I remember it. But yeah, so a lot of these new stadiums are built on the parking lot where the old parking lot was, and where the old stadium was gets knocked down. That becomes the parking lot. So there's a lot of those that kind of happen. So looking at this is a company that records, not the bond thing, but yeah, they issue a bond at face value. Now they're saying they're issuing it at face value. They're raising capital. They're doing debt financing by issuing an instrument that's saying we're going to pay back the principal, we're going to pay back the interest payments. Who wants the benefit? Who wants to be the beneficiary of this? Make us an offer. Now you could do it for face value, okay? But again, if you really understand, see, I've worked with people who I'm surprised didn't really know how bonds work. Debt is there's a principal value loaned, and then there's all the interest payments. Now with a mortgage, the principal repayment and the interest payments are all rolled into one payment. With a bond, there's a principal payment at the end, and then there's obviously lower number of cash flows that are paid out along the way. Okay, that's how a bond. And now also with bonds, a mortgage payment generally with a bank or mortgage or debt instrument in that respect, but a bond can have several investors. Taking if 4 different banks said, okay, we're going to raise $1 billion for Amazon, and everybody does $250 million pieces or slices of it. All the banks, there's one issue, but all the banks have 25% right to it, type thing. Corporation records bond transaction when it issues or sells. Yes. So, or it retires the instrument or issues the instrument. And the bondholder can convert it into common stock. I'll show you that example in this video. Yeah. So if the bondholders, if they have a right to those cash flows, but for whatever reason they need more liquidity, they want to sell that instrument to somebody else, they can do so, and they got to make up a price, for it. And like I said, we'll go through how the math on that sort of at some point in these videos soon. It says the issuing firm receives no further money. Yeah, that's it, right? They receive the principal, and that's it. Now they can issue at a discount, they can issue at a premium, and we'll go through those sort of scenarios. But this initial one, if the loan is whatever the loan is here, the loan is a $100,000 loan. It's issued, so Candlestick gets 100,000. Okay, so it says 100% face value. That's what it means. So you're issuing a $100,000 5-year instrument at 100, which means at face value, it's not 102, it's not 98,000, it's none of those. So again, the company getting the now, what is this? If you get a loan, what are you doing? You're getting cash instead of working, at Walmart or Amazon, the Amazon warehouse in Elizabeth or something like that. You're getting 100,000. And then your liabilities, you have $100,000 liability that you've got to cover, in 5 years. That's what the contract calls for. Okay, and on the 1st of January, when is this going to be paid back? January 1st, 2017, obviously, because 12, 13, 14, 15. So yeah, January 1st. So, and this is who initially writes that in. We're going to go into instruments in the next, which you will cover in this course. We're going to go in the next chapter, but I just want you guys to be clear how that works. Debit is left-hand side of the journal entry, and the credit is the right-hand side. This is a plus because it's a liability. This is also a plus because it's an asset. Cash is an asset. All right, to record the sale of the bond at face value. That's what we did here. Okay, it's a long-term liability section of the balance sheet. Fine. Okay, all that. Yeah, forget about the page references here. So we did that. We entered that. Did I type these? I forgot if I did. I forgot if I just. But yeah, these are just typed in. These are just simply typed in. So you said that already. Yeah. So now what you're doing here is it's going to be semi-annual interest. I hope. I think. Yeah. I think it's semi-annual interest. It didn't say it here, but usually it's semi-annual. Interest. And like I said, folks, please read all these entries, all the text up here. I'm skipping through, just doing the math as we go along, but you should be reading everything as you go along. So now, what do you have? You have a $100,000 face value note, right? Contractual interest is 10%. 5 years, 2 periods a year, and you want to be able to figure out the interest. So. And actually, whoops, this is 5. This is 2. Yeah, time in terms of a year, this is just simply equal to 2 divided by parenthesis 5 times, because there's 10 total periods. Yeah, just 1. It's just that, half. It's really just half. Okay, it's 2 periods a year, right? It's a half. So again, looking at this again in your mind, again for ease of discussion, January 1st, $100,000 of capital was raised, and when you get to July 1st, okay, that company's got to pay out the interest. And what is that interest? Well, the interest is 100,000, right, times 10%. Times a half, right? Times a half, which is right there. Okay. Yeah, times a half. So what you're doing is you're paying interest expense that's equal to 5,000 is paid twice a year. That comes out of cash. Okay. So under assets, when you're on the credit side, the asset is negative, right? And the expense is under the equity side. It's debit, which is positive, but with a negative on the outside. So the negatives can't balance. So you're looking at 5. And every 6 months, you have an entry like this. Now, this is recording a payment. We could change this to interest payable. This is an expense, and this recognizes that we paid out 5,000. But you can say interest payable, and then you're crediting that, and that's going to be a plus, and this is going to be a plus with a negative, and you're on the same side of the accounting equation, the liabilities plus equity side of the accounting equation, and they're going to cancel. Okay, so yeah, and like I said, so look, folks, there's no business is done in the language of accounting. Okay, so you've got to be used to debits and credits and having it explained in that manner. Actually, folks, look up here. See, we did 6 months over 12 months. Actually, we could have done it like that, right? 6 months over 12 months, right? Also 1 over 2, okay? But yeah, so interest paid semi-annually on the first. So yeah, so if you got the loan, now if it depends on the contract, you could owe the interest immediately. You get the 100,000. Okay, January 1st, you owe us 5,000, but this is where this is not. I forget what it was. It's not, you don't owe it initially. You owe it the first time after the initial date, a January or July happens. So if you get this in November, you could potentially owe interest, January 1st or whatever it may be. Okay, but again, it all depends on the contract, and the contract rules all, in these kinds of deals. And what the company's done in the past, the company's very married to, well, we did this in the past, we'll do it again. Very married to things like that. So just be ready for that. But there you go. So now this other, and see actually here, this is the other version of this, where again it's another interest expense. Okay, and this is just simply this. Now this, looking at the difference between the July entry and the December entry, this is just an accrual of the 5,000. Okay, this is an actual payment of the 5,000. This is an accrual of the 5,000. Okay. It's the company classifies interest payable as a current liability. Okay. And then schedules a payment for the next year. And then so what happens is, it'll pay off this liability the next year with $5,000. Okay, which is to record the bond payment. So there's the accrual of the bond interest, there's the payment of the bond interest. So you got to keep that in mind. Now, there's a little housekeeping, folks. I apologize for that. Save it as you go. And like I said, you're going to have, and there's the explanation here. It says when it pays the interest, it decreases interest payable. Right. So when you decrease a liability, you're decreasing it on the debit side, and when you're paying cash, you're showing you're recording that on the credit side, which is what we just showed you here. Okay. So yeah. So there you go. So you have when the loan is made or the instrument is issued. How does that affect the journal entries, and how does that affect the ledger of Candlestick Corporation? They're going to pay interest, and it shows you, we're showing you that. And when they accrue an interest expense, how they deal with that from an accounting perspective. All right, this is all finance, folks. It's not always doing accounting. It's not, okay? This is all finance. Okay. Okay, contractual interest rate, fine. Then there's a market rate, okay. Yeah, the market rate is computed when you pay upfront. If you buy that instrument, what you're paying for it, type of a thing. And again, we're going to go through the math. We're going to do the valuation math on that because it's very important. Okay, the market rate can change every day. Sure. Okay, that's definitely true. Okay. So yeah, so looking at this, it says, suppose that a company issues 10% bonds when the bonds of similar risk are paying 12% return, the annual return. So what you're doing is, if someone makes a loan of $100,000 to this company and they agree to those 10 $5,000 payments, they agree to the $100,000. There's a certain rate of return that they have. I think it's going to be the contractual rate when it's those numbers, but when there's a higher percentage out there. What you'll do is you'll front the company less than the face value, So you're increasing your return. So you didn't pay as much up front, and you'll get a bigger hit relative to what you initially loaned the company, on day one. Okay, but again, we're going to go through the. I can say these things. Going through what's going to make the most sense. I can say all that stuff, and I can picture in my mind because I do this all the time. That's a tough concept to picture, just because I said it on this video. So we'll get to we'll get to dealing with all of this. But yeah, so looking at this, yeah, we're going to talk about carrying value, discounts, premiums. This is all really good stuff. But yeah, here, let's pick up with this. So what's happening here? Yeah, you're here with this. So here, just using the Excel, the bond contractual interest rate is 10%. So if you're issuing the thing at face value, the return is 10%. If you issue the bond, if you don't pay the company 100,000, you pay them maybe 90,000, you could have a 12% return because you gave them less capital up front. Or if you give them, this is a hot company and everybody wants to make a loan to it, which can happen. They'll say, hey, we want more than face value, so we want 102,000, 105,000 or something like that. And people are fighting to loan to them because it's the next Apple or the next Google or the next, something like that, the next Amazon. So that can happen. Believe me, and the private folks in the private equity firm, it's a little club, and those guys get all the good opportunity. Believe me, that's just the way it works. They get the good opportunities first, and that's just sort of how that works. Okay, but like I said, there's a whole discussion here about market rates and discount rates and bonds of similar risk, and that's really what it is. You're always doing an opportunity cost computation with these kinds of problems. Always. You're saying, okay, if I'm going to get these cash flows, these interest payments, this principal payment, if I can get that someplace else and it's, it's Johnson & Johnson as opposed to a company we never heard of, I'll go with the Johnson & Johnson if it's paying the same. And that's why you get potentially, a better rate of return on sort of these unknown companies, but that you're also taking a bigger risk where Johnson & Johnson most likely is going to pay off. But if it's some biotech company in California somewhere, it may not work. What they're trying to do may not work. And folks, look at what's going on with this virus thing. I'm hearing there's 6, 8, or 10 different companies out there that are making tremendous research efforts to come with a vaccine for this particular virus, and they're mobilizing and enabling their very smart research scientists to work on this. And there's no guarantee that a Merck or a Johnson & Johnson or a Bayer or the big German pharmaceutical, there's no guarantee that some big pharmaceutical company is going to come up with the vaccine. It could be a company you never heard of. It could be a company in New Jersey someplace. It could be a group of guys working in a laboratory. And there's in the scientific world, there's a lot of that type of thing. It's not just plugging yourself into a big firm and that's it. Okay, when I'm not trying to knock big organizations, but you can lose your. I'm a very creative guy. You can lose your creativity when you just get plugged into a big place and you don't have to think anymore and everything's software driven and Bloomberg does all the computations for you, right? You have to think about anything. But I'm showing you guys how to think. I hope you're seeing that. Okay, so again, just very quickly, I just want to read through these before we get, because this is an important part. So here, I'm just going to sort of read this, guys. It says, candlestick, we assume the contractual standard interest rate and the market rate are paid on the bonds that were the same. A contractual interest rate is the rate applied to the face value to arrive at the interest paid in a year. Market interest rate is the rate investors demand for loans to fund the corporation. When the contractual interest rate and the market rate are the same, the bonds sell at face value. Okay. However, the market, the opportunity cost changes every day. Okay, so the type of bond, state of the company, the current industry conditions. So yeah, here's here's what impacts this, the value of financial instruments in the world. The type of bond, the type of instrument, the state of the economy, the industry conditions, the company's performance. Okay, that's what impacts what you're going to make on your stock buy or your loan to the company, whatever it might be. That's it. Okay, we should put a big thunderclouds around that. That's what impacts stock prices and financial instrument prices. How the economy's doing, how the industry is doing, how the company is performing. There you go. I mean, I should have that, and I should bold that out, to be very honest with you. So where is it? However, right here. Yeah, that was all really good stuff. Give me a minute to do this. Yeah, it can differ based on these conditions. Okay, it definitely can. Okay, that's very, again, every time I do these notes, I always look back and say, hey, this was important, that was important. So again, I'm always working on the Mona Lisa here. All the time. Every time I do this, I'm always working on the Mona Lisa. So the company issues 10% bonds when other bonds of similar risk can pay 12%. So yeah, so if there's other bonds of similar risk that they're paying the same interest rate, you might have to entice customers, say, okay, well, don't give me the 100,000, give me 95, and I'll give it, and then that increases their return because they paid less for the cash flows. Okay, it's like paying less for a car, less for some property, for real estate or something. So yeah, it says investors will not be interested in buying 10% bonds, so their value will fall below, the face value. When the bond is sold for less than its face value, the difference in the face value of a bond and selling price is called a discount. Okay, so as a result, the decline of bond selling price, the actual interest rate incurred by the company increases to the level of the current market interest rate. Fine. And then conversely, the market rate of interest is lower than the contractual rates. So investors will have to pay more than face. So yeah, so if the contractual rate is better than how other bonds are doing, then there's gonna be competition for that. And like anything else, when there's competition for something, you're paying a little bit more. So if the market rate is 8%, but the bond contract is 10, it's going to be bid up, and the bond is sold for more than the face value. It's sold for a premium. Okay. So it says something about showing something graphically. I don't know what that is, but let's see. Okay, well, it show. Okay, that's we just explained that. Okay, yeah, and remember this is the slide where these things didn't pop up right away, but yeah, that's what they're talking about. So okay, and like I said, you guys spend a little bit of time with that. Yeah, and this is just based on market conditions. This is not an opinion on, but it is in a sense. But it's not necessarily an opinion on how well the company is going to perform. But it is, though. This book says it's not, but I disagree. I disagree with this. It says does not mean the issue's financial strength is suspect. Well, price is confidence, folks. If what you're buying is less or more, it means if it's higher than what I want to pay for, it means other people want it too. If it's lower, that means people don't want it as much. So I disagree with that. I disagree with that. So we already filled this out, okay, which is fine. Okay, so let's hit the issuing it at a discount, folks. I know this is complicated. Okay, I understand that, but that's what you signed up for. You signed up for complicated. So now issuing this now. Again, it's a 5-year 10% bond, 100,000 in 5 years, and then 5,000. That's what you're buying. Okay, you're going to get 100,000 in 5 years. So if you just in your head you just do the math, you should be paying 150,000 for that or less, but then 150, right? Because you want to, if you're paying, if just nominally, forget about time value of money, but just you're going to get 100,000 5 years and $5,000 10 times. That's 50,000 plus 100. That's 150,000. If you're paying 160, why would you make that deal? You know what I mean? Because you're paying more than you're getting less. You're just giving away 10,000. So you want to pay 100. You pay 100,000 or even 110,000, but you don't want to pay more than nominally what you're getting. Okay, and on top of that, inflation is going to eat away at the purchasing power of those dollars in 5 years. So 100,000 5 years is not going to be like $100,000 today. It's going to be a little bit less. Okay, so you got to keep that in mind. So here, but this is just the initial transaction. Let's say it's going to be sold at 93 or 92.639% of face value. So it's a $100,000 instrument, and it's going to be 92.639%, which is right there. Excuse me. Okay, so what are you going to do? You're going to say equals 100,000 times the percentage of face value is 92, and now the discount is just simply the difference. And then you want to do a check just to add these up. Okay. All right, let's review. I know I did that a little quickly. Let's review. Again, you're going to make a loan to Candlestick Corporation, 100,000. Okay, but the conditions in the market are where 10% is not enough. In a sense, where I can go to some other company that's bigger, more financially stable and stronger, and they can give me the same deal. So I'm going to give you less. So to increase my return, I'm still getting the 100,000 and the 50,000 in interest payments. So I'm going to only pay 92,000 for it. I'm not going to pay 100. I'm not going to pay 105 or 102. All right. So then the company issuing the instrument and the company that's being financed by the debt needs to record somehow that they issued it a discount. That's how they do it. So again, now the Candlestick is still on the hook in 5 years for 100,000. They sold at 7,361 less than face value. So it means they only raised 92,000. So they basically helped. Or no, they didn't. They're basically gave a discount to their lender, to the person lending to them. They said, okay, so we'll add to your return by taking a little bit less money up front. That's what they're saying with this. Sale of bond at a discount. And then let's look at the balance sheet presentation, which is what we really care about. This 100,000. This is your discount, 7361, and we're going to net out these numbers. And here, let me hover over these. This is an input. This is that percentage times 100,000. Okay, and this is the difference. This one minus that one. This is just an entry. Okay, this blue font is an entry. Here we just took the numbers from up here. See, I took the face value and I took the discount, and then I put down the actual cash that the Candlestick raised. Okay, this is mid-year. We're not including any interest. This is just before the first interest payment is due. This is the carrying value of the bond, is what that is. Okay, that's a big word, so know that word. And actually here, I don't know why, carrying or book value. Yeah, we got to put this in here. This is issue of bonds below at a discount, below face value, causes the total cost of borrowing to differ from the bond interest paid. Must not only pay the contractual rate of interest over them, but also the face value rather than the issue. Yeah, so yeah, they're paying the face value, not the issuance price. The difference between the issuance price and the face value is the discount. Okay, it's an additional cost. Yeah, so for the company, obviously this is a discount to the person doing the lending, but to the company, this is an extra expense on top of the interest because they got to pay 100,000. So they're only getting 92. So right off the bat, they better make 7,361 from whatever whatever research development or whatever they're doing with this money. They need to produce another 7,361 just from day one, on top of all the interest payments, on top of generating the principal, on top of all that. Okay, and yeah. Let's learn and sort of how this is computed. I basically in here I basically just set it. Yeah, so you're going to do equal $100,000 times 10% times a half times parenthesis 10 times 5, right? Because there's 10 of them. Okay, so it's 100,000 times 10%. This is times a half, and then times 10, which is there's 10 of these payments made. So it's 50,000 in payments, and then the discount is just simply the discount. Okay, so the total cost of borrowing are just these. Now, yeah, but obviously without the principal, right? I just said that. I basically just said that. Okay. this is another way to compute the cost of borrowing. Yeah, actually, this probably should have been double underlined, double accounting underlined. This is the principal at maturity. And see, I'm always referencing it from someplace else, right? I'm always referencing someplace else. These are all the interest payments. The interest payments are here. Here's your 5,000, and there's 10 of them. You add all this, and the cash. This is cash. That's what's paid to the up to this point. That's what's paid to the bondholders, but also the company. You know, they received 92,639. So the net difference is was the cost to borrow. Again, 57,361. Okay. So here again, all I did here was I referenced. Whoops. I referenced the 100,000. That's where that came from. That first entry was 100,000. I just referenced it from there. This is the 50. So we computed the semi-annual interest payment already is 5,000. Then there's 10 periods, right? It's just multiplied, right? 5,000 times 2 times 5, and then we added these. This was the cash, again, cash received from bondholders. That was at 92,639. That was just from somewhere right there. Okay, that was from there. And then you subtracted. Okay, you just simply subtracted to get the difference. Okay, next one's a premium. We're looking at this at a premium. So this is the same bond payable. And now, again, the market calls for 108% of face value. And then the premium, again, you got to be able to record it someplace, and we're going to record it right there, and I'll explain, why it's recorded like that. So the cash the company received was 108,000. The liability was 100, but they also have to have someplace to say, okay, well, we took 108. So where do we record that? We record that on the credit side, which is it's really like a contra asset, right? We record that on the credit side though, as premium on the bond payable. That's to record the sale of a bond at a premium. And then what you're gonna do is you're gonna look at your balance sheet, which is what we always really care about. This was 100,000. Okay, this was the 8,000 over that we went, and this was just equal to the sum of we just added those. That's the carrying of book. And notice how I'm getting rid of the gray cells as we go along. So I'm just hovering over that little comment sign, carrying or book value. Okay. Again, notice the dates are important. In legal world, legal work, accounting work, the dates are always very important. You can never discount the dates. The sales above bonds, face value cause the total cost to be less than the bond interest paid. Yeah. So, and I'll tell you why that is. Yeah. So if you look at this right up here for the discount, I don't know if we said that, but we should have concluded somewhere that using this, because you got to cover the 7,000. See, with this one, you're only taking 92,639. You got to cover the contractual agreement to pay $100,000 back plus all the interest payments. In this situation, the bonds, when they're sold above face value, total cost to be less than the bond interest paid. Do we do? Yeah, actually, we're gonna do it. We're gonna do it next. Okay, and actually, what you're gonna find is that this is gonna be a lower number than this. Okay, you're gonna find this is gonna be a lower number than this. Excuse me, folks. Excuse me. Okay, we're gonna do the same math here. $100,000. Right, where is it? 100,000 somewhere. Here it is. 100,000 times 10% times a half times 5 times 2 right? Still 50,000, just like here, still 50,000. Now the premium is, you know, that when you sell your interest at a premium, you still owe the person who, you know, the person who lent you the money, you still owe them 100,000, but they paid 108 up, so they helped you with some initial interest payments, and we'll show you how to do the math on that next. This is going to be, yeah, so this is going to be, I'm looking for an inventive way of doing this. This thing -1 times 100,000. Yeah, that'll work. And these are subtracted, not added. These are subtracted. Yeah. So see now again, because the reason cost of borrowing is less is because you're getting from your debt financer an extra $8,111. So you can use that to pay off some of the interest already. So you subtract that from the interest that you owe. Okay, that means what these guys, the accounting guys said, I don't really agree with. It does, the price of this does impact what the market thinks of what you're doing. They said it didn't. I don't really, I can't believe these guys would say something like that. They really, certainly, price, you buy a house in Glenridge, New Jersey, or you buy a house wherever, you know, someplace in, you know, you fill in the blank, you know, someplace where houses aren't that expensive type thing. You know, obviously the Glen Ridge one is going to be a little pricier for a reason, right? It's quieter, all that, right? Not as much traffic, and everybody has a driveway, you know, I don't want to pick on anything. You know, being a guy from Newark myself, I want to start picking, oh, this neighborhood and that neighborhood. I want to start saying that stuff. But that's how you can see that. So, and then there's another way to do this. There's another way to do this. The principal, you're still paying that you still owe the 100,000, right? Which is right here. Okay. And then you have all of your interest payments times 10. So it's a $5,000 every 6-month interest payment times 5. So now, again, the people who are saying, you know, what's the Excel for? You know, hopefully you're seeing, you know, what it is that we're doing here, right? This is that 108. You can get that anywhere. And now looking here, you're going to say equals this subtracted. Because again, what's happening here? Let's explain why we did the moves that we did here. You're paying 150,000. You're paying 100,000 principal and then $50,000 in payments, and you received 108. So your cost of borrowing is 41,889. Okay, that's it. Oh, and actually here, what we could have done and should have done, and we'll do it next. Should take this. Because you know, this could be confused for I could be confused for what we're talking about with that. Pardon me, folks, while I do a little bit of bookkeeping here. So there we go. There we go. Okay. Again, every time I do it, I sort of look at it a little bit better. This is another example. You know, this is just simply another example of what we just looked at. There's $200,000 bonds. They're issued obviously at a discount for 189, and you want to see what the journal entry should look like, and what the balance sheet entry should look like, and how to sort of account for all of this. I did something here. Yeah, I don't know if you see these negatives as often. I put the negative in here, but maybe I shouldn't have done that. Maybe I should just worked it like this. Comma negative. Yeah. Yeah, discounts as a deduction from the payable, and a premium is an addition. So here, your face value of your bond is 200,000, and you're selling it at 95% of face value. So this is going to be equal to this times 200,000. This equals 1 minus this times 200,000, and this is the sum. Okay, I made sure that we were right. See how I did that? 94.5% times 200,000. Okay, this is the whatever 5.5%. 1 minus 94.5 is 5.5% times 200,000. Right, is 11,000. Okay, and then how do we, record that on our balance sheet, which is the most important thing? There's 11,000. There's the 2, and this equals this. Okay, that's Giant Corporation, the name of the company, and when things are due, and all that. All right. That's accounting for bond issues. We're going to just quickly look at retirements very, very quickly here, and then we'll call it a day. Yeah, because this is only 100 lines, and just since we're here, since you're here, we'll do it. I could have done this yesterday, but we'll hit this today. This is retiring these things. Issuing corporations retire bonds either when they buy back or redeem the bond, or when the bond was converted into common stock. Okay, so when you pay off your debt and it's a $100,000 note that you owe, you can write off your liability for 100,000, and then you decrease your cash account by 100,000. Okay, that's how you do that. The book value of the bonds at maturity equal if your company pays and records separately the interest with less interest period. This is the redemption of the bond. Yeah, this is the redemption of the bond. There you go. Yeah, now you can also do a redemption before maturity. Okay, you could do a redemption before maturity. Yeah, and I'll tell you, I'm a guy who, yeah, there's just two more of these. I'm a guy who likes to do the math, and you're always going to hear me say that. I like to do the math. So we're going to show you that, and again, my job is to make, to sort of expand what the book is sort of doing for you, kind of a thing. That's my job, to expand, and I will expand. And the book doesn't have it like this, okay? But I'm going to show you in Excel when you really model this stuff, what to do. Okay, so redeem bonds from maturity. Yeah. So you say, okay, we made a deal for 5 years, but 3 years in, I want to retire this debt. Sure, I promised you 5,004 more. 5,020 more times. You got to wait for it. Let's say we redeem it at, instead of 100,000, we redeem it at maybe 108,000. So take 8,000 and we'll call it a day, or whatever the deal. And that's just the deal that's made. Okay, like I said, these texts are trying to make everything seem so, this is going to happen and that's going to happen. You record what happens. I'm just telling you when things happen, how you record them is really what my job is. It's the wild. It still is. It's the Wild West out there. Don't think that it's not. Okay, it really is. So. Yeah, redeeming them before maturity is here. So, okay, we're here with this. So you eliminate the carrying value of the bonds at the redemption date, record the cash paid, recognize the gain or loss. Yeah, so obviously it gets much more complicated in terms of entries. The carrying value is the face value of bonds less any remaining bond discounts or plus any remaining bond premiums. And again, we're going to hit all that. So we're back to candlestick again. They made a deal that says, okay, we're going to retire this 8 years in, or so. I think it's 8 years in. Yeah, 8th interest period. All right here. Yeah, 8. Whoops. 8th interest period. So here, what happened? This candlestick received or accepted $100,000 debt financing. They agreed to pay $5,000 10 times. That's what they agreed to do. Okay. Yeah. Now, I'm going to put the negatives in. So here, it's right here. Remember we computed this last time? So yeah, those are your 10 interest payments. So again, candlestick accepted 100,000. We agreed to make all these payments, and also we agreed to pay back that principal. Okay, that's not, now again, taking time value money out of this. We took 100,000. We're going to pay you 150, is what we're going to do. Okay, but something happened here on our way to paradise. What is this telling us? Yeah, this is simply, and you guys can do it in your head, but this is simply the summation of all of those, and we put it there. But again, this is just, you know, if this thing went to nominally, if this thing went to maturity, that's what it would look like. You'd be surprised the people and the jobs they have and aren't. Okay, you'd be surprised. I was. that's for sure. So here, so we're now looking at this. We did this. Yeah, I put 17, but it's not. It's 16. Yeah, it's 16. This is 16. This should be 16. Folks, anytime this is a very complicated spreadsheet. There's always going to be things you have to fix and say, oh, I have to go back. I got to do this. I got to do that. Always. Never feel, oh, there's a mistake or whatever. It's not really a mistake. It's just, yeah, we're finding what we're doing. So looking at this, you're writing off the liability for 100,000. That's you're writing that off. Okay, that's what's happening there. At 8 years in, you're again the carrying. We didn't do a direct computation about this, but compared to other instruments that are out there, you're carrying this at this number, 101, 623. Like I said, and maybe a little more advanced course, we could go through how and why. We're gonna do that in this course too. But this is the carrying value, and then what else was this? Oh yeah, the premium. Yeah. So this was yeah. That's the yeah. So that it's $1,000, whatever. Yeah, 1,623. That is okay. That's what that is. So look at this. This is going to be. How'd we do it? We just subtracted. This is the premium that you're carrying it at. So you're on your books, you're retiring something that you had at 100,000 and then an extra 1,623. Okay, you're retiring both of those pieces. So you're retiring the whole 101,623. That's what you're doing. Okay. You're also saying, okay, we're gonna 103%, right, which is right there. Okay. So if you're retiring this thing at 103%, you're going to have this other computation that you have to maneuver here. You're retiring at 103, so that's what you're paying off at. Okay, you're paying off. So and again, what you need to do, you're saying equals that, or equal whatever, 100,000 times 103, but that's all the same thing, which is right there. And you have one computation left to make. Now, here's the question. Are you going to subtract 103 from 100,000? Are you going to subtract 103 from 101,623? It's the second one, right? So look at this. Now, for better or worse, looking at sort of how you're doing this on the books, you carry this bond. And again, it's all relative. Is it the person making the loan? Is it the company? Is it Candlestick? Is it their financing people? The people doing the financing for the company. Who's gaining what and who's losing what? If you're carrying something on the books for 101,623, you sold it for 103 type thing, pardon me. you had a liability for 101,623. To get it off the books, you paid 103. That's not a gain, right? Obviously, that's going to be a loss. So, right, so you're subtracting this and that, right? That's how you get the 1,377. Okay, that's how. So again, you had an instrument on your books. You had, on the books it says you owed 101,623, but you paid 103, so you paid an extra 1,003 to get rid of that liability. Is what you're doing. So you're operating at a loss right there, and then you want to do a check right there. That's your check, 103. Just that whole debit column added up. And what is, the loss is the difference between the cash paid and the carrying value. Okay, that's what that is. Save. Okay. So yes, you're carrying it at these two. You're carrying it at 100,000 and 1,623. All right. You paid 103 to get that liability off your books. So you obviously, you're operating it because it's an instrument, right? And again, when you think about this, saying, okay, well, I'm paying this, but you're also taking the debt off, so you don't owe it anymore. You're paying more than you owe. All right, and that's what you're doing is you're paying extra to save on the future interest payments for a couple of years. So that's pretty good, right? So if I paid 1,377, right, and I don't have to pay, these other, I don't have to pay 10,000, right, or whatever it is. Yeah, because you're 2016. Yeah, so I have to pay an extra, 10,000. I'll pay 1,000. Again, people make that deal. They do some computations themselves. That's your job to come up with this loss for the company. It's got to be known. This is okay. We don't like it, but we'll pay it anyway. Type of a situation. So again, save your work as you go. And again, this is just an entry. This is a subtraction, right, from those two. This is, a subtraction there. This is a multiplication. Actually, this is just this. I could have done the same thing here. I could have done the same thing right there. Folks, I know this is complicated, but that's, these are, when you're selling instruments, how do you record losses and how much did you pay for? That's what's going on out in the world. There's two more of these to go. This is the same thing. This is the same thing. And actually, what we may do, I always like to break things up a little bit too, because the loss thing, that this can be very tricky. I might just put a red line there. Well, we're going to do the conversion, but here we're going to pick the next video. We're going to pick up right there for the next video. So let's just do this one, and then we'll call it a day. Convertible bonds. So yeah, so what you have here is you have a debt instrument, and you want to convert it to shares. Is really what you wanted to do. So Saunders, they want to convert a $100,000 loan into 2,000 shares at $10 par. Now, there's always going to be a market value for those shares, but that's not really what's going to come into play. And again, whose sheet are we looking at here? This is the company. This is Saunders' sheet. Okay, they're going to retire that debt. Okay, it's not the person. It's not the financing person's sheet. This is the people receiving the debt financing. They're going to retire that stock, for that bond, that debt instrument for 100,000. You're going to say, and actually, probably what I should have done was something like this: copy, paid, shrink it, $10 a share. That's the par. And then I always should have had something in here. Let me go to the beginning. I knew we had it here. Copy. This is going to be, I could jam it in down there. What is this? This is this. Whoop. There. So this will be equal to the $10 of par times 2,000, and this is just the extra right there. And we're making sure. But yeah, so Saunders Association, that's how they would make this computation. It doesn't consider the market price and any of this. I mean, it does, but it doesn't show up in the computation directly. Yeah, there's a market value. Let's see, what are we doing here? It says both the bonds. So yeah, so 2,000 shares of the common stock are worth 130,000. So that's 2 divided by 130 is whatever. 65, is that 65,000? I think, yeah. Yeah, that's per share market value. That's what that is. Home copy right there. Yeah. Okay, so that obviously doesn't come really into play. So it's a conversion of the debt instrument into equity, and this is the equity account. Credit is the positive equity account of Saunders, and they're saying, okay, now we have another $20,000 in stock, and 2,000 more shares converted. And this goes back to that initial problem that we had at the beginning of the video today. Okay, like I said, the next video is probably tomorrow. We're going to start here because I'm going to do another one. I want to let this sit, just let it sort of ferment a little bit. So we have that on the docket for tomorrow. We have account for other. This next one is going to get, this is the mortgage installment payment, and the journal entries, and there's a couple of these. So again, this is something too. I might just cut this in half a little bit too because there's leases. We have some leases here. Okay, and then we have the presentation part of this and some of the ratio analysis. But I like to break things up. Then we have the comprehensive problem. So yeah, there's a couple more videos coming, folks. I'm going to post this. Okay, I'll put the video up. I'll put the latest version of this Excel. But like I said, you should be copying and pasting, those files, and you should be really trying this, walking this around the block, yourselves. Okay, but this is what we're doing. This is how the course is going to work. So I hope this helped you. You got to watch these a couple different times. I know it's complicated. Okay, but this is money. And like I said, there's firms out there that teach how to do all this, and fortunately the school saw value in bringing me on about 10 years ago. I can't believe it was 10 years ago. It was about, a little bit less, but about 10 years ago. This October, November, it'll be 10 years, I think. But to just have some experience, have a guy experienced with this, where you can get a job doing this stuff. Okay, so put that in the in the computer that you're learning a good job skill by doing all this. We have a long way to go. Okay, we have a long way to go. Okay. All right, folks. Again, always wonderful spending time with you. I hope that helped you. That's our first Excel video. We have a lot more of these coming, and keep reading the book, and you're gonna have to repeat doing this a couple times, and hopefully it'll be a good 6 weeks. And for some of you, you've been working for a month already. For a couple of you, working about 3 weeks ago. Good. But this is what we're teaching. Okay, like I said, take your time. Review the videos as many times as you need, but you got to watch it. Okay, you got to watch the videos. Okay, folks, we'll see you soon.